Energy powers the world. Utilities keep it flowing. They are not the same. Today, a clear, beginner-friendly breakdown in 5 minutes. Stay to the end for investor use cases and examples. First up, what are energy stocks? Energy stocks are companies tied to producing, refining, moving, or selling energy resources. They live across the energy value chain, from exploration to retail. Their fortunes track commodity prices like oil and natural gas. Coal and uranium can matter too, depending on the business. Global supply and demand shifts ripple directly into energy earnings. Expect cyclicality and volatility. Upstream explores, drills, and extracts oil and gas. Revenues swing with commodity prices. Midstream moves and stores energy, often under fee-based contracts. Cash flows can be steadier than drillers. Downstream refines crude into fuels and chemicals and sells to consumers. Margins depend on crack spreads and demand. Renewables, solar, wind, hydro, bioenergy are growing parts of the mix. They follow policy, costs, and power prices. Energy equipment and services supply rigs, tools, and expertise. They thrive when drilling activity rises. Geopolitics and OPEC decisions can swing prices fast. Economic cycles drive fuel demand. Logistics and storage bottlenecks add shocks. Expect bigger drawdowns and bigger rebounds. Now compare that to utilities. Utilities focus on delivering energy services with stability. Different business model, different risk profile. Let's draw the line clearly. Investors treat them very differently. Next, features, examples, and how to use them. Onward. Energy companies sell energy commodities. Utilities deliver energy services under regulated pricing. Energy is highly sensitive to oil and gas prices. Utilities are less tied to commodity swings. Energy tends to be volatile. Utilities tend to be stable. Energy dividends can be inconsistent. Utilities often pay steady, predictable dividends. Energy for growth and inflation hedging. Utilities for income and defense. Oil and gas majors include ExxonMobil, Chevron, BP, and Shell. Large-scale, global portfolios. U.S. exploration and production. ConocoPhillips, EOG Resources, Occidental Petroleum. They hunt for barrels and molecules. Midstream and pipelines. Kinder Morgan, Enbridge, Williams Companies. They earn fees to transport and store. Energy services. Schlumberger and Halliburton support drilling and completions. More activity means more revenue. Renewables. NextEra Energy, First Solar, Brookfield Renewable Partners. A hybrid like NextEra mixes utility and renewables. Electric utilities deliver power to homes and businesses. Names include Duke Energy, Southern Company, Dominion Energy. Multi-utilities like American Electric Power and Exelon span power and gas. They manage grids, rates, and reliability. Water utilities include American Water Works and Essential Utilities. The focus is dependable service. Utilities often operate under regulated pricing and approved returns. That can stabilize earnings and dividends. Energy companies face commodity cycles head-on. They expand in booms and retrench in busts. Key distinction: selling commodities versus delivering services. Two different engines behind the cash flows, and two different roles in a portfolio. Let's match each to its job: growth, inflation hedge, or income and defense. You're almost there. Energy stocks can hedge inflation when oil and gas prices rise. They offer growth and upside during expansions. But expect bigger drawdowns and rebounds. Utility stocks provide steady income and lower volatility. Dividends are often predictable through cycles. Utilities tend to be more resilient in recessions. Think cyclical energy versus defensive utilities. Blend them based on your goals and risk tolerance. Not investment advice. Research companies, fees, taxes, and your time horizon. For utilities, study rate cases, debt, and payout ratios. For energy, know break-evens, reserves, capex, and hedging. Recap: energy sells commodities across upstream, midstream, downstream, services, and renewables. Utilities deliver regulated energy services. Use energy for growth and inflation hedging. Use utilities for income and defense. If this helped, like and subscribe for more beginner-friendly finance. See you in the next video.